Hey, welcome back. Make money count. Today, we're going to talk a little bit about the Bank of Canada announcement that just happened. Unsurprisingly, the governor of the central bank has held the overnight rate where it is, which means the prime rate will maintain itself at a very lofty 7.2%, which for anybody in a variable rate mortgage is not helpful. What is helpful, the bond yields are significantly lower than where they were weeks ago. Bond yields are down. Our other favorite market, the CDOR market, is indicating huge drops in interest rates coming in 2024. This is all a result of how poorly the Canadian consumer spending and confidence is faring. This idea of threading the needle into a soft landing is really predicated upon decreasing interest rates quickly enough to get the consumer back into the market, something that we're a little bit worried about. If the consumer doesn't come back to spending and doesn't have confidence, it's going to be difficult to restart our economy. This idea that these high interest rates need to stay longer, we kind of continue to hear that verbiage from the Bank of Canada. The Bank of Canada didn't really make a nod towards decreasing interest rates at all in their statement, and we didn't expect them to do so. Again, remember, the Bank of Canada is the parent that's over-parenting us right now. They gave us way too much sugar over the pandemic. Now we've been sent to our rooms. They locked the door. And we've been in there for so long that when they unlock the door and ask us to come out again, we may be too stubborn and not want to come out. I feel like in no other aspect of our lives do we so intently rely on and listen to anybody that has this much power over us other than the Bank of Canada, who is so consistently overshooting or undershooting. I mean, we've gone through this process of, okay, inflation is temporary. They came to grips with the fact that it wasn't temporary. They hammered us with hikes from early 2022. Now, the economy is sounding the alarm on what's going on. Like, we're in a recession. The Canadian consumer has left the building, and the Bank of Canada is coming out saying we still kind of see some inflationary pressure. Inflation is lagging. It's a lagging indicator. We need to start looking at the leading indicators, the things that are killing our economy right now. The idea that we need to kind of continue this verbiage from the Bank of Canada of being so tough on the economy and tough on inflation in a time when everybody sees that inflation is gone. The overly restrictive policy that we have in place right now needs to be adjusted. We spoke about this a while ago in a podcast where we discussed that interest rate hikes and interest rate decreases have an effect over a period of time. We are still going to feel the impact from previous hikes ongoing right now. It illustrates itself really clearly in mortgage maturities. We've talked about this at length too. Every single month, 150,000 Canadian consumers have to refinance their mortgage or renew their mortgage into significantly higher rates. That is more and more of this restrictive monetary policy bleeding into the economy and further contracting the economy. The sooner we can get onto an accommodative policy, at least reducing rates by 25, 50 basis points to telegraph to the market that we are now going to try to bring the consumer back, the better. You can see it nowhere better than the CDOR market right now. CDOR market, again, we discussed the market for buying and selling the future rate hikes or drops, in this case, of the Bank of Canada. Obviously, we're not going to see a rate drop of 25 basis points in December, but by March, they're now allocating a 35% chance of 50 basis points lower on the overnight rate, which we have not seen before. 75 for 75 in June of 2024. So 75% chance that we're going to be 75 basis points lower by the midpoint of 2024. I guess the question everybody's got to ask themselves is, does that mean the consumer comes back? Does that mean we can resurrect the housing market? Does that mean that confidence comes back into the marketplace? I hope so. Again, we have to be worried that too much doesn't come back in to kind of re-stimulate inflation. I read another very interesting article from David Rosenberg. When you extract the growth of immigration's impact on the economy, we're actually like in close to negative growth right now for the economy. Like, never mind inflation, deflation. So this external input of additional humans coming to live in Canada is providing a growth impact on the economy. And when you take that out, the economy is contracting. The idea that inflation is sticky and still in our economy, I think we got to get rid of it now. We need to start focusing on getting the consumer back to healthy. The idea that we need to continue to issue these statements and keep the overnight rate at 5 with the prime rate at 7.2, it's gone. It's gone. And the sooner that this trend of an overcorrecting central bank can leave us and we can get back to, as we always say, George Clooney on the spaceship, little micro changes to change the direction of where we're going instead of these wholesale massive rate increases and rate drops and quantitative easing and quantitative stimulus. Let's get it back to a healthier place where you don't have to drop rates by 2.5%. I suspect in 2024, remember that CDOR chart that we just looked at, if you looked at it 2 months ago, would have been calling for 50 basis points of rate drops in 2024. I expect we're going to see more than that. A good central bank doesn't have to increase and decrease interest rates by 150 basis points in a year. That means that they've lost control over the economy, or it means that they're not reading the right instruments, the right data points that are coming out of the economy because they're overcorrecting and they're getting surprised too often. Monetary policy isn't meant to be used like a blunt instrument. This is my takeaway from today. I think that, if you're waiting for interest rates to drop, 2024 is your year. If you want to get back into the real estate market, now's the time to start looking at things. The problem I feel as though the longer we leave interest rates where they are, the more pain will continue to come into the marketplace, and we could see further price drops on real estate. There you have it. TIFF, cut rates. Cut them now. #HeyTIFF, cut the overnight rate 50 basis points today. If you like listening, remember, please to like and subscribe. That helps us with the Google algorithms. Remember, like and subscribe to our content and you'll get more of it. Thank you very much.